Hello and welcome to the Currency Exchange, a NatWest FX podcast where we run through the major themes and events that are driving currency markets this week and into the next week. I'm Tokunbo Lawal, and I'm thrilled to be joined by Kevin Cummins, our chief US economist, and Ian Vanderhorn, our US desk strategist, as we do this North American special. So Kevin, I'm going to come to you first. We had US CPI this month. This week, the print appeared in line with consensus. How are you thinking about that going forward?
Yeah, I think, as you said, it came very much in line with our expectation heading into the number. It on a year-over-year basis, the number actually didn't make any further progress as expected relative to earlier in the year when inflation was really showing slowing through the summer and into the fall on a year-over-year basis. So I do think it raises some uncertainty with regard to whether or not inflation is going to get back down to 2%, just looking at that metric alone. But kind of going through the numbers themselves and the report in detail, I think it's probably a little bit better than expected because things like rent prices and, the heavily weighted owner's equivalent rent component, which makes up a pretty good size of the core. If you add in residential rents, it makes up about 40% of the core index, came in softer than we were thinking. So those numbers don't bounce around too often, but we did see a nice step down there, and it was pretty broad-based within the regional data that we get on rent. So that was very favorable, and I think that gives us some comfort to the idea that the stabilization of the past couple of months and kind of this stalling out in inflation is more of a one-off, and that our expectation that inflation over the course of the next 3, 4, 5 months for a resumption of our earlier downtrend was supported by those data. So we're feeling pretty good after the report itself with regard to the near-term outlook on inflation.
Thanks, Kevin. And with the Federal Reserve meeting next week, how do you think that this week's print, does that change your outlook, or are we still expecting a 25 basis point cut?
Yeah, so going into the report, anything obviously can happen in unknown data report. But I think really from the Fed's perspective of whether or not they were going to cut by 25 or not, you know, the driving factor, I'd say, was the jobs report that we had earlier this month, on the 6th of December. Markets are fully priced for them to go by 25 basis points in December. I think we're still waiting for, Wall Street Journal, Fed insider Nick Timiraos to probably kind of seal the deal. I would imagine after seeing this morning's data on the PPI and the details from that report, that will carry over to the Fed's preferred measure of inflation, which isn't available until 2 days after the FOMC meets on the 18th. Those data are available on the 20th, but they'll have a pretty good gauge and view on where they think that report's going to come in at. I think have to be pretty encouraged by this week's inflation news. In the wake of these data, it seems like the core PCE is either going to be up 0.1 or 0.2. And that really didn't change in the wake of this morning's report relative to our expectations. So, we'll see that, a 0.3 on the core CPI that the Fed is well aware of, and obviously that came out yesterday. But the core PCE data were very encouraging. You have to go back to June of 2021 to see such a soft reading. So I think for the Fed, it's only one report, but it's certainly moving in the right direction, and it'll give them confidence that inflation hopefully will get back down to 2% before not too long. I do think it will give some Fed officials some cover to remain a little bit less willing to cut rates next year. So I think things like the FOMC statement or, the dot plot, for instance, or the overall tone used by Powell, kind of signaling the data are allowing the growth related data have held up good enough that it's allowing them to be pretty careful here and cautious about cutting consecutive meetings. So I think they're going to open up the door with some flexibility and signal that they're not in a hurry to cut rates. They could hold off from a cut in early 2025. I doubt Powell will explicitly say that they're not going to move in January. I think he wants as much flexibility as possible because I think, the unemployment rate only rounded to 4.2 from 4.1 the prior month last week, but it barely rounded to 4.2. It almost rounded up to 4.3. I think it was 4.246. So, the Fed's carefully watching that. And I think that kind of solidified them going again this time at next week's meeting. But I think they are probably unwilling at this point to really say too much about the January meeting per se.
So we expect the statement to sound a bit more cautious.
The statement itself, I think, um, will probably be very similar to the November edition, with one caveat in the opening paragraph. The language on inflation may not sound quite as convincing that inflation is going to get down to 2%, or the data are moving down in that direction. They are probably going to acknowledge that there's been a little bit of a stalling out of progress there. But the rest of the statement, I would think, other than just announcing another 25 basis points and the new target range, will likely be identical. I think one of the risks going into this week's data was whether or not you'd have a dissent at the meeting. For example, Governor Bowman, when she spoke earlier this month, she did say that, she's going to be looking pretty closely at the inflation related data and seeing how they come in. Our official call is that there won't be any dissents. I think she'll go along with it with the idea that, the policy guidance is going to be much less dovish. So, for example, the dot plot as of September, the last time that officials made projections out into future years, they were assuming 100 basis points in cuts next year. I think they dial that back and probably cut it by about 50 basis points. So I think they're only going to show maybe another 50 basis points in easing. Now it seems like, the economy's holding up very well. We've had this kind of stalling out for the most part on inflation, that, I think it's going to allow them to be a little bit more cautious, and the terminal rate may not be down as much as they thought. So, I do think that they're probably going to nudge up that terminal estimate as well, and kind of they've been very gradually nudging that higher, and I imagine that they're going to do it again next week.
Brilliant. Thank you, Kevin. Turning to you now, Ian. Bank of Canada delivered another 50 basis points rate cut. What was the reason behind this decision?
Yeah, first of all, thank you for having me on. Like you said, yes, yesterday they delivered a second consecutive 50 basis point rate cut. That puts them at 175 basis points of total easing in the cycle, and puts them at a policy rate of 3.25%. So behind the move, really, I think, was proof that the Bank of Canada is a very growth and output gap focused central bank, as in growth was not at the levels that not only they expected it to be, as put out in the October monetary policy report, which included their set of forecasts, but also not at the level of potential growth that they see in the Canadian economy, and thus the output gap is still higher than they would like it to be. Notably, also alongside the decision to cut 50 as opposed to 25, was that they really seem to have sort of a suppressed outlook for growth going forward as well. This decision did not contain a new round of forecasts. That will come in January with the January 29th meeting. But in the press conference, Governor Macklem was pretty cautious about growth going forward. Specifically, he kept talking about lower immigration in 2025 as a potential source of lower growth. And as a reminder, Canada's policies are set up to allow for a significantly lower amount of immigration in 2025, and the Bank of Canada clearly sees that as a downside for growth. So 2 points here. I think one was to get in front of current growth, but the second was to get in front of future growth going forward. Lower immigration notably could also ease price pressures in Canada. You have less people consuming, you have less people going after the same units of housing. That could potentially ease housing prices or rental prices. And the hope for the Bank of Canada is that per capita consumption can pick up and sort of offset this. But that will happen with a lag, and it will happen sort of in a push-pull relationship. So it won't be really net stimulatory going forward. And then if we look at inflation specifically, because it was only a few months ago that the Bank of Canada was so highly focused on inflation rather than growth, we did have a little bit of a rebound in Canadian inflation in October. Both core measures of inflation picked up, and especially on a short-term annualized basis, which is very important to the central bank. But really, I think some of that could have been expected just because September inflation was so soft. We actually saw headline inflation below the 2% target in Canada in September. So some give back was accepted there. And I think the Bank of Canada understands that the inflation story is going to be a bumpy road, but the risks are actually to the downside, as in undershooting their inflation target. And that too means that they can go 50 and potentially support growth to avoid that situation. So Bank of Canada is in a very unique situation whereby these 250 basis point cuts, they're actually being done to support growth rather than just explicitly exit restrictive territory. Although with that said, the Bank of Canada's estimated range of neutral rate of policy is between 2.25 and 3.25%. So with this latest 50 basis point cut, this puts them right at the upper end of that estimated range of neutral. So in their minds, they're teetering on the edge of being out of restrictive policy.
So Canada now focus on growth, and as you rightly said, inflation appears to be softening, and then they're going to be pressured from immigration. Should we expect a third 50 basis point rate cut from the Bank of Canada?
I really don't think that's on the cards. And the Bank of Canada forward guidance given in the statement and in Governor Macklem's press conference was pretty explicit by saying that, their expectation is that they're going to be more cautious with interest rate cuts going forward. I think that probably means that not only could a pause be on the table in 2025, but also that any additional moves from here are most likely to be undertaken in 25 basis point intervals. That's certainly our expectation, especially now, as I said, they are at the upper end of their estimated range of neutral policy, which means they can be a little bit more tactical in here in making more cautious and smaller cuts as they move lower into that range of neutral policy. I think importantly, one of the things that is a risk to this outlook and suddenly does introduce the risk of more easing quickly is something that Governor Macklem also talked about a lot in his press conference because he was asked about it a lot, which is the potential of U.S. tariffs given the threats from U.S. President-elect Trump, specifically the threat of a potential 25% blanket tariff on Canadian goods. Under that scenario, Macklem said it would be detrimental to the U.S. To the Canadian economy, of course. And they're not accounting for it in policy currently. He said they're not going to account for policy that doesn't yet exist. But he said that it's already potentially having an impact on Canada's economy because there are Canadian businesses that may be more cautious to invest and spend on CapEx if they are expecting the U.S. to implement a 25% tariff. So that's a downside risk to growth that could elicit maybe a potentially faster pace of easing by the Bank of Canada. That said, we really don't think a blanket 25% tariff is likely at all to be implemented on Canada by President-elect Trump. That would raise prices at the pump for U.S. consumers, pretty much on day one that it's implemented. And it also just wouldn't really accomplish much if Trump is threatening this tariff as a solution to, loose border policies. That's, you know, pretty much exclusively, I won't say exclusively, but it's mostly an issue that exists with Mexico. We don't think it's very likely, but it still is a risk, and it still could be weighing on the Canadian economy, specifically Canadian businesses.
So with all this in mind, Ian, we've got an aggressive central bank easing, the threat of tariffs, at least in the background. How are you thinking about the Canadian dollar going forward?
Yeah, we've been bearish the Canadian dollar certainly going into this decision. Post the decision, we did see the Canadian dollar find a little bit of support actually, um, which we think makes sense. You know, CAD has had a lot of headwinds this year. Not only are we talking about relative rates from monetary policy, we're talking about the threat of tariffs, like you said, a bleak outlook for Canadian growth, and then you have the potential headwind of lower energy prices into 2025 on what could potentially be a year of excess oil supplies. Um, the largest headwind for CAD has been that relative rate story. And with this last 50 basis point cut, that headwind could see temporary relief, mostly because we're seeing it in pricing for the Bank of Canada going forward. The markets right now are pricing just 50 basis points more of cuts, or roughly 50, in the first half of 2025. When we put that next to expected easing for the Fed, it's not too different. Markets are currently pricing about 60 basis points of easing for the Fed in the first half of 2025. So what that means is that we could see some relief in relative rate spreads between the US and Canada, which could continue to act as one tenet of support for dollar CAD. I say that with a caveat because we are pretty negative growth in terms of the outlook for Canada. Those yield spreads could widen, particularly if you do see expectations for the Bank of Canada terminal rate start to move lower. Right now, it's at about 2.75%. We've seen some estimates of as low as 2%. Personally, we're somewhere in the middle. And then just further, the longer term headwinds are still in place in our view. Like I said, energy prices could be lower. Canadian growth isn't expected to see a turnaround anytime soon. And those tariff risks are really weighing heavily. So under a worst case scenario, we could see dollar CAD potentially test the 5-year highs, which were seen back in 2020.
Brilliant. Well, I believe that's all we got time for. Thank you to Ian and Kevin for joining me. And thank you to our listeners for listening in. And as a reminder, if you've liked this podcast, please remember to like and subscribe to the page to get notifications when our next episode's release. Thanks again.